Hello everyone, my name is Zach and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. $1 million doesn't always mean $1 million, especially when it comes to your net worth. And mainly that's because of this pesky little thing called income taxes. So if you have a $1 million of net worth and you cash it all out and turn it into cash, you might not have really $1 million of net worth after that because you might lose some of it to income taxes. And that's what we're going to discuss today. We're going to go over some hypothetical scenarios here saying that you have $1 million in each of three accounts. Okay, in a Roth account, in a traditional account, and in a regular brokerage account. So those are the three scenarios, but I do have to make some assumptions that apply to all. The first assumption I'm going to make is that this person that we are talking about in all of these scenarios, they are over the age 59 and a half. So basically they don't have to worry about paying a early withdrawal penalty from any type of retirement account. The second assumption that I'm going to make is that their filing status is married filing jointly and they have no other like tax deductions or tax credits or anything like that. We're just going to calculate how much taxes they're going to pay based on them liquidating $1 million and having $1 million of income that year. And then another assumption I'm also going to have to make here is that they live in a tax-free state, like an income tax-free state, or at least they moved to an income tax-free state before they realized $1 million of income, okay? That's probably a good idea. So they're living in Florida, they're living in Texas, and maybe they're living here in Tennessee with me. So something like that, they're going to be living in a state where they don't have to pay income taxes, so we don't have to calculate that out. And the big question that this video seeks to answer is, how much do you have left after liquidating $1 million of assets? Whether you have $1 million in your Roth IRA or your kind of like a Roth 401k or something, whether you have $1 million in a traditional IRA or a regular 401k, or if you have $1 million in your taxable brokerage account, your regular brokerage account, how much money are you going to have left over if you liquidate an entire $1 million? Let's start with the easiest one here, and that is the Roth, such as a Roth IRA. So this one is really easy because if you have $1 million in a Roth IRA and you don't have to worry about early withdrawal penalties, then theoretically, if you liquidate $1 million out of that Roth IRA, then you should technically still have $1 million. And that's because Roth IRA withdrawals, like qualified withdrawals, they are going to be tax-free. Because the theory is here that you've already paid taxes on the amount that you put into the Roth IRA. You didn't get a tax benefit up front. The money grew tax-free, and when you withdraw it as a qualified distribution, you get to take that money out tax-free. So this is the most ideal scenario. If you have $1 million in a Roth IRA, then you should have $1 million if you convert all that to cash and take it all out in 1 year. So that is the easiest one. You'd still have $1 million. And speaking of Roth IRAs, I love the Roth IRA, and that's why it is a cornerstone of my personal financial independence strategy. So a strategy that I'm personally using is known as the Roth IRA Ladder, okay, but we'll talk more about that later at the end of the video. Let's go ahead and move on to the next account, the next hypothetical scenario. Okay, it gets a little bit more complicated than the Roth, just having all of your $1 million, and that is a traditional IRA, or let's say a traditional account, like a regular 401k. If you have $1 million in this type of account and you liquidate it all and take it all out, you're going to be taxed on that entire amount as income. So it's going to be as if you had $1 million of income that year. And that's because traditional accounts, like a traditional IRA, the tax status of those are tax deferred. So you're just deferring taxes on all the money that you have within that account until you take it out. And if you happen to take it all out at once and it happens to be $1 million, then you're going to be taxed on $1 million. So how that works is that you get the tax deduction up front for the money that you put into it, and then it grows tax-free within the account, and then you take it out and you get taxed right then and there. So for this scenario, it is also easy to calculate how much you're going to pay in taxes, but we do have to do a little bit more math here. So remember I said that we're going to calculate it as married filing jointly. You also get to take the standard deduction, which is a certain amount of income that you get to take tax-free regardless of what your income is. And for 2022, that is $25,900. And then you start to enter the marginal tax brackets. Okay, it starts at 10%, then it goes to 12%, then it jumps all the way up to 22%, 24%, and so on and so on. But withdrawing $1 million all at once from a traditional account and having $1 million of taxable income, that is going to put you in the highest federal marginal tax bracket. And currently in 2022, that highest bracket is 37%. Some of your $1 million is going to get taxed at 37%. You're not going to pay 37% of all of your income. That's why we have the marginal tax brackets, but this is where our little math comes in. So I tried to do my best here, and hopefully I got this right. I think I did this right. So I put in the marginal tax brackets, and you can see on the screen, I estimated that you're going to pay about $294,964 in federal income taxes if you had $1 million of taxable income. So the math here on how much you actually pay in taxes is pretty easy, and that is 29.49%. So that's your effective tax rate. That means of that $1 million, you lost about 29.5% of it to federal income taxes. you get to keep $705,036. A little over $700,000 you get to keep, and the other goes to the taxes. However, if you even want to get to that $1 million in the first place, you're going to have a good solid foundation of knowledge. And that's why you need to like this video if you're enjoying it so far, because then YouTube is going to recommend more of my videos to you, and you get to watch more, you get to learn more, you get to gain that foundational knowledge, and then you yourself can get to $1 million and then have to worry about paying taxes on it. No, seriously though, if you're enjoying this video so far, please make sure you like it. It really does help me out, and I would really appreciate that. Now let's get on to the next one, and this one is probably the most fun, and that is the taxable brokerage account. All right, so this is also the hardest one to calculate because there's so many different factors. And so I have to add in some additional assumptions here. One of those additional assumptions is, what is the tax basis going to be like? Because a taxable brokerage account works a little bit differently than those retirement accounts. The basis is how much money you put into it, how much you actually contributed yourself, what you actually paid for those investments. Now, here's the scenario I'm going to present for the taxable brokerage account. We have a hypothetical person, and they achieved financial independence in about 10 years. So they started in 2010 and they ended in 2020. They were contributing $4,000 per month, and their asset allocation was 80% US stock, which is VTI in this case, and 20% bonds, which is BND. Those are both index ETFs, exchange traded funds offered by Vanguard. And using Portfolio Visualizer and backtesting that, they should have a final balance of just over $1 million, like $1,080,000. And their tax basis is going to be how much they contributed in this circumstance, to keep the math easy here. So I put in that they put $4,000 per month, and they never increased that amount for 120 months or for 10 years. And that means theoretically their tax basis should be $480,000. That's how much money they put into the account. So the $1 million that they're going to take out of the account minus the $480,000 that they contributed to the account, this should be about $520,000 of taxable income. Now, another assumption I do have to add in there is that I'm going to assume that these are all long-term capital gains. Okay, so this is where things get really interesting. So let me put the long-term capital gains rate on the screen here for you. You can see that a lot of them are going to first be taxed at 0%, then at 15%, and then over a really high number, it's going to be taxed at 20%. So that is a lot lower than the regular income tax brackets. And in our scenario, they're actually only getting taxed on $520,000, not the entire $1 million, which means that they're actually only going to fall into the 15% tax bracket for long-term capital gains. And that's why I have this little estimate I'm going to put up on the screen for you. And I estimate that they're actually only going to pay $61,583 of long-term capital gains tax on this $1 million of cash that they're taking out of their taxable brokerage account. And the reason for that is that, like, the first $100,000, it's a little over $100,000 if you're married filing jointly, is going to get taxed at 0% because you have the 0% tax bracket for long-term capital gains and you have the standard deduction. So I added those up and those should be 0%. And then you have the next marginal tax bracket of 15%. So that's where other taxes is going to come from. Whatever's left over, it's going to get taxed at 15%. So that's how I figured out that calculation. Based on my estimation, they should keep $938,418. So you get to keep a lot of that money. In this circumstance, if you have long-term capital gains in a taxable brokerage account and you contributed money into there all those years, then you're not going to pay that much taxes based on the current long-term capital gains rate. Now that we've looked at those three account types, I want to know from you in the comments below, what are you personally working on building up the most? Which of these three types of accounts are you personally working on building up the most for your financial independence or the most for your retirement? Are you building up the Roth, the traditional, the taxable? Are you building up all three? Please let me know in the comments below. I'm really curious to know. And now, like I mentioned earlier, the Roth IRA Ladder is my personal investment strategy, like my personal strategy for my financial independence. And if you want to know more about the Roth IRA Ladder, and trust me, you should, because I think it's a great strategy for most of us to achieve financial independence, then definitely watch this next video that I have for you, okay? It's going to pop up on the screen right next to me after I get off the screen. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.